All right, welcome everybody. This is Scott Chang from findmywayhome.com. I will be joined here shortly by one of our expert lenders from our expert network. If you've been paying attention, we are interviewing some of the top loan officers, mortgage brokers that I know and personally know and trust. We've been doing a series with Evan Wade over in Philadelphia. We're doing some series on some VA guidelines that have been changing. And today we are going to be on with Mia Schultz, and we are talking about student loans, about qualifying for a mortgage when you have student loans, and specifically IBR payments or income-based repayment plans. Now, how we got here in 2015, all of the guidelines, so for FHA, VA, USDA, Fannie Mae, and Freddie Mac for conventional, they all started changing the way that they calculate student loans and payments for student loans when you're qualifying for a mortgage. So specifically what we're talking about here is your debt to income ratio. So if you've spoken to a lender, you've probably heard this term. And essentially what a debt to income ratio is when you're qualifying for a home, the amount of home that you qualify for is your new housing payment, including all of your debts that show up on your credit report as a percentage of your gross income before taxes. That's what it normally is. If you're self-employed, it's a little bit different. If you have different kinds of income, it's a little bit different. Now, where the challenge comes in is with student loans, because a lot of student loan debt out there is either deferred or it's in forbearance, or there's a variety of different repayment plans. So this really started changing in around 2015. So these guidelines are only a few years old, and they have changed multiple times within those 3 years. So we're going to kind of go through this. So let's see. So essentially the biggest challenge. So the purpose of doing this is, if you've followed Find My Way Home, we're a consumer education site. I'm a mortgage professional. I've been doing this for 20 years. I focus on educating and empowering consumers to make more informed decisions. I take this very, very seriously. I do this as a career. This is my full-time job. I love doing what I do. Now, the rest of the industry, or a lot of the industry, especially if you're hearing about a lender on TV or on a radio show or something like that, or even online or anything like that, these companies have massive money. They're putting it to get in front of your eyeballs. And then a lot of times you call the number, you fill out the form, or you click the link, and you're connected with a telemarketer that's sitting there that doesn't know the guidelines, and they don't really know what they're doing. Well, this gets all kinds of people in a huge mess, mostly because your options or your ability to qualify for a mortgage essentially is limited to the experience and the expertise of the person that you're talking to. So a lot of these companies, I call them telemortgagers. You get on the phone with one of these 20-something kids in a cubicle that doesn't know anything about mortgages. They take your phone call. Their job is to fill out an application, collect your credit card, do whatever, get you to the next stage of the process. Now, where all of our traffic comes from, and we've been doing this for about 10 years, and we've had over 1 million visitors to this website in the last 10 years. And almost every single one of the visitors to our website talked to another lender first and were misled or misguided or straight up lied to and told at some point in the process, no, I'm sorry, I made a mistake. You don't actually qualify. So this is a huge one. Let's roll this back. 2015, Prior to that, if you had a loan that was deferred or in forbearance, the underwriters used to be able to prove that there were no payments going to be due for the next 12 months, and we didn't have to do anything with it. We could completely ignore your student loans. Well, in 2015, all of that changed. So now all of a sudden there's this guideline out there, and if you have student loans and if you've been through this process and if you've talked to another lender, you've heard about the 1% rule. And essentially what happened is all of the underwriting guidelines, all of the people that make the underwriting guidelines, people upstairs, they said if there is no payment being reported, you must use 1% of the balance of the student loan when you're calculating your debt to income ratio. So remember I said when you're trying to qualify for a loan, you're using your current your new mortgage payment, your proposed mortgage payment, plus everything that shows up on your credit report as a percentage of your gross income. Well, there's a lot of people out there have 20, 30, 50, 100,000. Our record so far is between two people. A couple had $998,000 in student loans. Now, the payments on those student loans was not 1%. That there's no way anybody would ever qualify for a loan. They were on income-based payment. So your options now. Right around 2015, what really got popular were income-based repayments and public service forgiveness plans. And so what this meant is if you were a teacher or you worked in the public service space and you had student loans, you could make your payments for 10 years and then your student loans would be forgiven. So in that time, you could base your payment based off of your actual income. Well, it was based on your residual or your expendable income or your extra income after all of your bills were paid, and it was kind of a calculation that said you have this much money left over at the end of the month. So we're only going to adjust your student loan payment. That payment can be zero, and it is zero a lot of times because your student loan is going to be forgiven at the end of 10 years. You're in the public service space. You work for the county, city, state, or you work for a school district. Listen, your education loans can be forgiven. So what happened in 2015 is this all kind of went crazy, and all of the lenders, well, for the most part, all of the lenders created rules that said the payment cannot be zero. It must be fully amortized. What does amortized mean? Amortized means that you have to have a term for the loan, so it has to pay off within a certain period of time. And most student loan lenders will have the what am I trying to go for here? They'll have a schedule. So based on the total balance of what your student loans are, they'll calculate what your payoff term is. I believe if you have over $60,000 in debt, you can spread out the payments over like 20, 25, or 30 years. Inside of that, it's usually about 10 or 15 years. So you take your student loan balance, and an amortized payment means that your monthly payment, if you make that payment every month, very, very similar to if you are buying a car, right? So you have a car, you make your payment every month, and in 5 years, 3, 5, 7 years, you pay your car off. Well, that's the same thing as an amortized payment with student loans. So that's an issue because a lot of people they're going to have their loans forgiven. So they don't want a fully amortized payment. They don't have to take an amortized payment. They are entitled to an income-based payment, which could be zero. So what happened is Fannie Mae, FHA, VA, USDA all had this amortization rule where the loan had to be fully amortized. There was a little loophole. So Freddie Mac is an underwriting guideline. If all of this sounds crazy, I'm embedding this video on a blog post that's going to explain all of these things. So you don't need to be scribbling notes. You don't need to try to follow through with all of this. we're going to get you answers to any questions that you might have. So Freddie Mac simply did not come out with guidance that said that you needed to have a fully amortized payment. So this was a loophole. Very, very few lenders knew that this loophole was out there. Very, very few lenders even know how to do Freddie Mac underwriting on a conventional loan, which is very, very similar to a Fannie Mae loan, but they're just not quite as popular. There's small nuances. So for the longest time, Freddie Mac was the only one. We had been on top of this since 2015. So I've been following these guidelines since 2015 and stayed dialed into these things since 2015. So that was the case for years. Then what happened is VA actually changed their guidelines, so they have a calculation now. You cannot use an IBR, income-based repayment, but you can use this special calculation if it's not fully amortized. Freddie Mac actually in January of 2018 changed their guidelines. So now you have to use a 0.5% calculation if you have an income-based payment, or if you have a zero payment, or if you have deferred or in forbearance. And then Fannie Mae actually came out earlier this year in 2018, and they came around full circle and said, we will accept an income-based payment even if that payment is zero. So where are we today? Where we are today is these are complex guidelines. Somebody like me who's been in the business for decades knows these guidelines, understands these guidelines, and have been on top of these changes. The challenge is when you're picking up the phone and calling a lender, you're essentially playing guideline roulette, and you never know if you're going to get a loan officer that is a professional or that takes their job seriously, that actually understands what they're talking about. And I can tell you they don't always. More often than not, they don't. Maybe not more often than not. I'm not going to make that statement, but I'm telling you, many, many times a day, I get phone calls, I get emails, we get inquiries from people saying, hey, I talked to 3 lenders. They told me 3 different things. So actually, what inspired me to do this video is I have just been bombarded with emails and comments on the website from people that are getting in these situations where they are in the loan process. They talked to a loan officer, had no clue what the guidelines were, pushed the loan through, and here's the fatal problem with this. Ignorance is the fatal problem, because your loan officer gives you approval. They give you a pre-approval letter. You hand it to your real estate agent. Your real estate agent makes an offer on your dream home. Then you get your offer accepted. You think everything is just hunky-dory. Process your purchase, your real estate transaction is in process. You're 1 week down the road. You're 2 weeks down the road. Guess what? You get 2 weeks, 2 days before you're supposed to close, and the underwriter comes back and says, you never knew the guideline. You cannot do this calculation. We have to use 1% of your student loan balance to recalculate the payment. Guess what? Now your debt to income ratio skyrockets through the roof. You no longer qualify. You go online, you type into Google, holy crap, IBR, student loans. You found findmywayhome.com. You end up talking to me, and I introduced you to somebody that I know that has experience with these guidelines. So what are the solutions here? There are a couple of, I would say, creative ways to approach this. The first way that I want to discuss is if your payments are deferred or in forbearance. So if your payments are deferred or forbearance, you're in school now. You do not have to make a payment on your loan, on your student loan. What do? Well, the best thing that you can do is your first shot at it is I would go for a Fannie Mae approval, apply for an income-based payment. So you can contact your student loan lender, fill out the application, and get qualified for or get approved for an income-based payment. If you get an income-based payment, again, that payment might be zero. It might be $5. It might be $25. It's really just based on your income and your debts and how much money you have over at the end of the month after you pay all your bills. So this can vary widely. That is a really, really good strategy. When you do that, that is going to make you eligible for a Fannie Mae conventional or a conventional loan using Fannie Mae underwriting guidelines. Now, here's one of the challenges. Fannie Mae is not always the easiest type of loan to qualify for. The debt to income ratios are a little bit more restrictive than an FHA loan. FHA is much more flexible. However, FHA will not allow you to use an income-based repayment. So this is a tough one. You want to hopefully you're seeing this, hopefully you're being proactive and you're seeing this information prior to going out and shopping, and I can get you in front of somebody that knows what they're doing first, or you can at least maybe guide your loan officer to the right guidelines. But with an income-based payment, you can absolutely do this. Also, if you need to use an FHA loan because your debt to income ratios are not good enough, or if your credit scores, that's another big difference between Fannie Mae and FHA. Fannie Mae has a minimum credit score of 620. There are some lenders that have overlays. They require even higher, but FHA can go down even below a 600 credit score, and there's much more flexibility. There's much more wiggle room in your debt to income ratios. However, so you cannot use the IBR payment. You have to use a fully amortized payment. So here's where it gets kind of tricky. If you need to contact your student loan lender. This is it. This obviously isn't scripted out. I'm rolling on this stuff, and I've just been bombarded with these things. So you contact your student loan lender and find out what your options are. You don't necessarily have to commit to anything. Now, here's another interesting thing that happened in our industry. It used to be years ago, you could contact your student loan lender and you could get a document from them that would say what your payments will be if your loan was fully amortized, right? So if you had a set payment and a set payment plan, and we would be able to use that, you wouldn't actually have to go into a repayment plan with your student loan. That will still work. All the underwriter is looking for is a statement that says what your fully amortized payment is going to be. We're going to qualify you based on that payment. It does not mean that you have to be in repayment. So that's the one thing that I would try. So if you're in a situation where you have to use an FHA loan because of whatever reason, so you need the debt to income, your credit scores aren't perfect, you need a lower down payment with your down payment, credit score, loan to value combination isn't giving you an approval with a conventional loan, contact your student loan lender, see if you can get this statement. We have found it increasingly more difficult to get this statement from your student loan lender. I do not know what the answer to that is, other than I would go through the process as far as you can to apply for an amortized student loan payment until you can get a statement that says what your payment is. So, is this a sure thing? Not necessarily, but it's something that you can try. Another option that I wanted Mia on here, but Mia appears to be having technical difficulties, so I had no intention of just rambling on all by myself, but here I am. But what Mia's brilliant. So if you've come to Find My Way Home, there's a really good chance you've talked to her. I've introduced you to her. She has been doing this as long as I have, and she's incredibly creative with these things. There are websites out there that will essentially show an estimate of what an amortized payment would look like if you punched in your student loan balance. Now, we do not have an answer from HUD yet, but Mia is actually in the process of presenting this to HUD to see if we can get a printout from this website. It's like studentloan.gov. I don't even know what the website is. Once we get confirmation, we'll post it here. So that's your options. Your options are, if it's deferred or in forbearance, the first thing you can do is talk to, again, you want to talk to a professional. Stay away from these guys that are these telemarketers that are just trying to get your credit card and fill out a loan application without having a conversation like this with you first. Last week, I interviewed Evan Wade. He's on the Find My Way Home on the Expert Network. Every interview that I've done with our experts, we always have a detailed conversation with you before we say, give me your loan application, give me a credit card, let's run your credit, all this kind of stuff. We want to get to know what your situation is. And if you're on Find My Way Home, you're safe, because here is a safe place and I have experts that I can introduce you to. But if you've just found us, maybe we can explain why you've been having challenges getting approved. So number one, see if the loan officer believes that you could qualify for a Fannie Mae underwritten loan. If you can, it's very easy to contact your student loan lender and apply for an income-based repayment. Now, the reason why income-based repayment is by far your best option is because that payment is always going to be lower than a fully amortized payment that's going to pay off your loan in full at the end of a specific term, especially if you have a public service forgiveness program or forgiveness loan. So the second option is if you have to go FHA, let's look at it. We can run the tables. We know approximately what your interest rate is going to be. Very first thing, contact your student loan lender. Find out if they will give you a statement that says, if I started repaying this loan to pay off at the end of a term, what would my payment be? If they give you that on a piece of paper, on a document, doesn't have to be paper, it could be digital. If they give that to you on a document that shows that it's clearly from your student loan lender, it can't be an email say, yeah, this is your payment, has to be a statement from the student loan lender. If you can get that from your lender, you do not have to be in repayment status. You just need to show what that payment would be, and then that payment is going to be used as part of your debt to income calculation for qualifying for your loan. So if you're on Find My Way Home, sign up below for our newsletter. If you're in one of these situations, anytime these guidelines change, we are on top of it. I write 1 to 2 articles every single week, and we send it out. They're not all going to be 100% relevant to you, but someday one of them are going to be. If you're watching this on Facebook or on YouTube and you have questions, drop me a question. I will answer your questions. I will connect you with an expert that has experience with these guidelines, and we will get you pointed in the right direction. First and foremost, again, if you're being proactive and you're seeing this before you're trying to apply, have this conversation with your loan officer. If your loan officer does not have this conversation with you, if they cannot explain to you what the student loan guidelines are, hang up, get the hell out of there, because that loan officer is not an expert. They are not a professional. They don't do this for a living, or they just don't read their guidelines and they're not concerned about learning what the guidelines are. So I hate to be harsh like that, but there's a lot of good people that don't know what the hell they're doing, and they're out there giving you advice. And I can't tell you, nothing hurts me more than all of the contact that I get from consumers like you that are in escrow and you're supposed to be closing next week, and you're told that your loan doesn't qualify. the tears, the heartache, the disappointment. Luckily, a lot of times we can turn that around and we can get it saved, but a lot of times you can't. So there you go. That's my spiel on student loans, IBR guidelines. If you're watching this, wherever you're watching this, it should be very easy to reach out to us to get answers. Thank you very much for being here, and I really hope this helps you find your way home. All right, have a good day.